Okay, what's going on, everyone? We are picking it up here in chapter 4, part 2. Last time we learned about the income statement, right? We looked at continuing operations, discontinued operations. That's great. We're now going to move to the statement of comprehensive income, which presupposes that we talk about what comprehensive income is. Right, so we had our income statement we talked about, right? Our revenues minus our expenses gets us our net income. What we're now going to do, right, is add or subtract to that amount our other comprehensive income, which will land at our comprehensive income. Okay, that's just kind of the lay of the land. Let's talk now about what some of these things mean, right? So when we talk about other comprehensive income, right, that's just a fancy way of saying, hey, we have up here, when we did our revenues and expenses, a certain rule set that told us what is a revenue and what is an expense. We are now going to expand upon that, right? Have a more comprehensive view and have some other gains or losses that we didn't include above, right? So, what are some examples of other comprehensive income, right? One would be unrealized gains or losses on available for sale securities, right? So we'll talk about in a later chapter the difference between like trading securities and available for sale securities. But say you buy a security, right, like a stock at $100, and at the end of the year, right, it's worth 150, right? It has appreciated in value by 50, but that is an unrealized gain insofar that we didn't sell the stock, right? It's just kind of like a holding gain. It could be the reverse, right? It could be an unrealized loss that we subtract. But the idea with this is that $50 increase, we didn't include it up here, but we would include it down here. Another kind of example might be foreign currency translation adjustments, right? So we have maybe like a parent company, right, that's located in the US. Let's just say it owns 100% of a foreign subsidiary. Let's just say it's a French company. At the beginning of the year, right, the exchange rate might have been like 1.2, and let's just say our equity was 1.2 million. Right, at the end of the year, that exchange rate favorably changes to 1.4. Right, so now our equity is 1.4 million on there. That increase of $200,000 on there, that would be considered a positive foreign currency translation adjustment. We didn't include it up there, but we would include it down here. It could be the reverse, right? It could be a negative, right? That's why it's plus or minus. Other items you might see are certain pension benefit plan cost adjustments that would go in there. But we'll look at more of them as we go through. Okay, and when we talk about this, right, that's great. We have our net income and our other comprehensive income. It's kind of like we're maintaining two separate piggy banks, right? Our net income we store into our retained earnings, and our other comprehensive income we store in our accumulated other comprehensive income. Both of these are on the balance sheet in the stockholders' equity section, right? So they're kind of like two different piggy banks that we maintain that have two different rule sets, right? It's almost like this is our cash piggy bank, and then this one is like our Bitcoin piggy bank. It's a little bit broader in what we count as income. So you can see here, right, here's an example of a statement of comprehensive income on there, right? You get your net income, you make your other comprehensive income items on there, your adjustments 30. Overall, right, your net income plus or minus your OCI gets you your comprehensive income. You could do this as a single statement, right? Your revenues minus your expenses gets you your net income, plus or minus your OCI get you your comprehensive income, right, in one entire statement. Or you could do two separate statements, right? Your income statement, your revenues minus your expenses get you your net income, statement one. And then statement two, right, you would start with that net income plus or minus the OCI, get you your comprehensive income. Either one is fine, right? Both are acceptable on there. So we talked a little bit about other comprehensive income is like a piggy bank, right? So with net income, if we think about that, right? That goes into retained earnings, right? We have our beginning retained earnings plus our net income or minus our net loss, minus our dividends gives us our ending retained earnings, right? That's great. It's like a piggy bank for our net income. We have a second kind of piggy bank for our OCI, right? We'll have our beginning accumulated other comprehensive income. We'll add or subtract to that our OCI for the period, and that will get us our ending AOCI on there. It's a balance sheet account under the equity section, right? So that's kind of what this is showing, right? Imagine that we had, an increase in retained earnings, right? So functionally, our net income was 500 for the period. Functionally, our OCI was 30, right? We have for our retained earnings, our beginning plus our net income, right, gives us 2.5. For our OCI, right, our accumulated, the beginning is 200 plus our OCI for the period, 30. These guys are like those piggy banks, 1 and 2 on the balance sheet in the stockholders' equity section. Okay, so it's just almost like if you had a checking and a savings account, or you had two different bank accounts at different banks. Same kind of concept, but what goes in those bank accounts is different. Here's an example of a comprehensive income as its own separate statement. So again, you could prepare it separately from the income statement, and then this is just showing you, for example, those kind of two piggy banks on there in the shareholders equity section, right, where we will have our kind of retained earnings and our AOCI. Okay. One thing to be aware of is that AOCI is a little bit like a holding pattern in the sense eventually, ultimately, we will classify or reclassify these items into our retained earnings. So you can look at that. It says which of the following is not an example of OCI. Unrealized loss on available for sale, that is. Foreign currency, yep. Derivatives are another example that's in there. Income from sales, right? That's going to be a revenue on the income statement. We already accounted for that. Okay, so that's the statement of comprehensive income. Nothing too bad, right? We will now move into the statement of cash flows, right? At a very high level, right? It's your beginning cash plus or minus, right? Namely your inflows and your outflows from your operating, investing, and financing activities get you your ending cash. This operating section, we can prepare it either the direct method or the indirect method. Under the direct method, we just list out our inflows and outflows, right? Similar thing for these guys down here, right? We just list out our inflows and outflows. It's not any harder than that. The indirect method, though, is a little bit more complicated because we start with our net income, right? We'll use that as kind of a proxy for our operations. We're going to have to make some adjustments to that, and we can get to our operating cash flows. Whether you do it the direct method or the indirect method, it gets you to the same ending point on there. Okay? So it says here, which of the following is true concerning the statement of cash flow? So all of the above, right? A, it can provide information about that's helpful in assessing profitability, liquidity, and solvency. It shows cash receipts and disbursements on there, right? So cash in, cash out. It is required to be presented for any period for which an income statement and a balance sheet are presented, okay? When we look at our statement of cash flows, right? Imagine we just have all our journal entries we did for the period. Any ones that involve cash, we have to kind of sort it. Is it an operating activity? Is it an investing activity? Or is it a financing activity? And did we get cash or did we pay cash, right? So we'll look at each of these starting with the operating activities, right? Kind of the O on there. So we have our inflows and our outflows. I like to think of our operating activities as just kind of, hey, we're running our business on a day-to-day basis. The most common thing you're going to see, right, is just sale of our goods or products, right? We're providing the goods or services and they give us cash. On the flip side of that, right, all of those kind of traditional operating expenses on there where we pay cash would be associated on it. So that's kind of what I think of the operating activity section, like how we run the business on a day-to-day basis. There are some other things you have to be aware of, though, like interest and dividends we receive from other companies, right? As well as interest on notes receivable are going to be part of here, an operating inflow. And then on the flip side, if we pay interest on there, that will be an operating outflow. Okay, so it's basically going to be how we run our business on a day-to-day basis, and then interest and dividends that we either, in this case, receive on there from our investments in other companies, or interest that we pay on our debt. For example, our bonds payable, our notes payable, the interest on those is here. Repayment of the principal and distinction would be in the financing activity. Okay. We said there's two ways to get you there, the direct and indirect method. The direct method is exactly that. It's not that hard, right? You just look at all your transactions that were related to cash, which one fit in that kind of operating bucket, and then you just list them out, right? So we had some cash received from customers. That's a plus. We have cash paid for general and administrative. We had cash paid for taxes. You net them all together, right? It gets you to 55 on there. This kind of same framework, the direct method, is going to be very similar to how we do the investing and financing section, right? It's just plus minus, plus minus, plus minus, whatever fits kind of in the box for that category. The only place it gets a little bit different is when we use the indirect method. The indirect method, right, essentially what we're doing here, and a lot of times this is required for large multinational corporations, right, we are going to start with net income, right, because we're looking at our operations. That's kind of like a good starting point, but the problem with it is that is based on the accrual basis. So we can't really use that number by itself. We have to undo or kind of get rid of those non-cash items on there. So what we'll do, right, we will have overall, right, some things that we're going to add to that amount. We will have overall some things that we subtract from that amount. Oh, geez. Okay, we're good. And that will get us to our cash flows for our operating section, right? So here, right, we start with our net income, right? This is an example of an indirect method. We add some things, we subtract some things. Hey, it's going to get us to 55 on there. In the same way that the direct method got us to 55. So let's talk about what we add and what we subtract, right? From what we add on there, right, there will be certain things that are kind of non-cash adjustments. And that goes both ways, right? So non-cash adjustment here. And then we'll have certain non-cash adjustments down here. The most common, right, what you're going to see, for example, is depreciation or amortization. You're going to have to add that back. Because if you think about net income, right, we subtracted depreciation to get to that amount. That has nothing to do with cash depreciation. It's like purely a GAAP concept. So we have to undo that depreciation. If we subtracted it before, we have to add it back on here, okay? Outside of that, right, we are going to look at the change in the account balances for our operating assets and our operating liabilities. Similar to Chapter 2, whenever we looked at how to convert from the cash basis to the accrual basis, and we said, oh, okay, you can look at the change in account balances to see if there was overall more revenue or more cash paid for a particular account. We can do a similar thing here, right? And essentially, right, so when we look at the change in the account balance, if it was an operating asset, right, you would have your beginning, your additions, your subtractions, your ending. If it went from 100 to like 150, right, it was an asset, right? It went from there to there. The change for the period was 50, right? So we have an asset that went up during the period. Okay? We would have a certain rule over here in our cheat sheet that tells us what to do. So here's the rules, kind of like this, right? If we have a decrease in any operating assets or we have an increase in operating liabilities, we're going to add all these things back, right? So depreciation, decreases in our operating assets, increases in our operating liabilities. We do the reverse down here. We subtract on there, right? Any increases in operating assets, any decreases in operating liabilities, that will get us to where we need to be on there. Okay, so this is just showing that kind of example like, oh, okay, we had an increase in an accounts receivable, right? So that would be what? Asset plus on there. It looks like for that reason, right, if we go back to our cheat sheet, we have increase in operating asset. We're going to subtract that. Hey, that's what we're doing right over there, right? So we follow that little cheat sheet, that little framework to help us get from net income to our operating cash flows. Nothing too bad on there, okay? Talk a little bit about the investing activities, right? We have our inflows and our outflows. Typically what this is associated with, right, is when we buy, investments, right? And don't worry about like getting super, bogged down in the weeds for this, because again, in later chapters, we'll look at like trading versus available for sale. But for right now, just think of this section like we're buying investments or we're buying PPE and intangibles, right? We're buying or selling this stuff. Okay, so anytime we have an inflow related to those, it would be here. Anytime we have an outflow related to those would be here, right? The investments that we make in other companies. Financing activities in distinction, right? We have our inflows and we have our outflows are related to generally our own company, right? How do we finance our business? If we want to grow and get bigger and move to a new geographic region, how do we finance that? Maybe we issue stock, maybe we issue bonds, right? So this is related to essentially, right, from the inflows, right? If you issue stock, you sell stock, you get cash. If you issue bonds, if you issue a note payable, right, you issue it, you get cash, right? That would be the inflows. The outflows would be things kind of related to those, right? If, for example, we bought back our own stock, treasury stock, if we paid dividends on our own stock, right, that would be a cash outflow. And if we repaid the principal of our bonds or our notes payable on there, that would be here. Different story if we paid interest on that amount, though. That would go up to the operating section. So you have to kind of keep things straight in your head. But here's an example of a statement of cash flows, right? We have, our beginning cash down here. Right, so there's our beginning, 102. We have our operating of 55, that's a positive. We have our investing, which is 40, that's a negative. We have our financing on there, which is a positive. If we look at the change between those, right, if we net them, right, it's going to be 20, right? So if we do 102 and the positive 20, hey, our ending cash, beginning plus or minus the operating, investing, or financing activities, we end at 122. That will be the cash that's on the balance sheet, okay? You can look at this kind of non-cash investing and financing activities on there. They give us some MCQs here, right? Which of the following items would not be included as cash flow from operating activities in a statement of cash flows? Purchasing machinery, no, right? That would be the investing section, right? These other ones, though, are all related to operating on there. Here's a good one for the direct method, right? We're looking again at the operating section here. We said you have the direct method. Right here, we'll look at an MCQ, and then we'll look at the indirect method. So we have a company, they reported revenues of 7.5 for its year, so that must have been sales from our customers. Accounts receivable at 2026 to 2027 were 480 to 532 on there. And using the direct method, how would we kind of report cash flows here, right? Well, it would be the 480 plus the 75 minus the 532, we're looking at 7447, 500 on there. The indirect method, right, you can read through this, but you start with your net income, right? You look at the changes essentially to your operating assets and your operating liabilities, as well as those kind of non-cash items. And then that will get you to your cash flows from operating activities, okay? Next, we're gonna look at some ratio analysis. Right, so starting here, right, we're gonna look how we utilize and manage our assets, right? So we're gonna look at, among other things, kind of activity ratios. For example, the asset turnover ratio, namely our net sales over our average assets, and then our receivable turnover ratio, namely our net sales over our average accounts receivable. One thing I do wanna call your attention to is if it has average down there, we're gonna have to do a little bit of math, right? So it would be like our beginning total assets plus our ending total assets, right? All of that divided by 2. Okay, so it's kind of like an equation within an equation. And what we're looking at here with these activity ratios, again, is how do we manage these assets? The average collection period, which builds off that receivables turnover ratio, really tells us, right, how long on average does it take for us to collect on our accounts receivable on there? 10 days, 20 days, right? Things like that. Inventory turnover ratio, right? We're looking here, among other things, in how we manage our inventory on there. So you can do that and then figure out the average days in inventory. And then we could also look at some profitability ratios on there, like profit margin on sales, return on assets, return on equity. Anytime we say the word margin, we're kind of getting at, like, what are your profit margins? How profitable are you? That would be your net income over your net sales. Anytime we say the word return on, again, you're looking at profitability, because what's my return on investment? What's my return on my assets, on my equity? All right, and again, be aware some of these have that average amount at the bottom where you have to do some math within a math. Return on equity, another kind of variation of that, is this dew point framework. So you can look at that kind of equation there, write it down on there. They then have just an example here, right? So we have a company they begin the year with inventory of 220. At the end of the year, their balance was 185. Cost of goods sold was 900. Can you please calculate the inventory turnover ratio and average days in inventory, right? So for our inventory turnover ratio, if we go back up here, right, it's going to be cost of goods sold over average inventory. They tell us up here that our cost of goods sold was 900. That's great. We'll then have to do our average inventory, right? Beginning 220 plus 185 divided by 2. Hey, our inventory turnover ratio is 4.4. Well, if you know that, right, the other ones have to be wrong because there's no other distractor there. But if we then look and we build upon that, right, we want to figure out our average days in inventory. We take that ratio, we carry it down, right, 365 divided by 4.44. Hey, our average days in inventory are 82.21 days. Okay, so that's going to be it for chapter 4. We'll finish it up here and we will see you in the problems video.